Good morning, good afternoon, and good evening, everyone, and welcome to Revenue Accounting and Auditing Essentials for Early Stage Entrepreneurs with KPMG. My name is Colin Mahan, and I'm a program director at the Nasdaq Entrepreneurial Center. And for those of you who may not know, the Nasdaq Center is a nonprofit improving access and knowledge in entrepreneurship to advance economic progress for all. As you're going to see in the chat in just a moment, the Nasdaq Center provides programs, resources, and exceptional mentorship to help entrepreneurs fuel prosperity no matter where their journey begins. Be sure to check out those links and resources in the chat. Now, we're going to launch a few polls to step back and take a temperature gauge on how all of you are doing today. We use this information to guide the programs we provide for this global community of entrepreneurs. If there are specific topics or challenges you'd like us to create resources for, feel free to share them in the chat. Couple more housekeeping items before we get started. Firstly, let us know where you're dialing in from by dropping your location into the chat. We'd love to see where everyone's joining us from. Secondly, we're going to have a live Q&A near the end of our event, so please submit those questions at any time using the Q&A function at the bottom of your screen. We'll do our best to get to as many as we can. Now, while you're answering, I'd like to take a moment and recognize the incredible support of our corporate partners. The work we do at the center wouldn't be possible without the generosity and belief of our partners and funders, including Nasdaq, Wells Fargo, JP Morgan Chase, KPMG, Walmart, the Asian Innovation Hub, Wilson Sonsini, the REIT Foundation, and BPM. We're deeply grateful for their partnership and hope you'll join us in sharing that appreciation too. So without any further delay, please join me in giving a warm welcome to our special guest. Oleksandr Saychuk is an Audit Managing Director at KPMG. Oleksandr, welcome.
Hello, everyone. Welcome to
So,
the event.
so happy to have you. Over to you.
Thank you, Colin. Let me present the slides and we'll get started.
Looks great.
Thank you for the confirmation. So again, welcome everyone. As mentioned by Colin, we're talking about revenue accounting and auditing. In today's agenda, we'll talk about the importance of revenue accounting. I'll do a quick revenue accounting one-on-one session on five-step model. I do want to talk to you about the implementation guidance, and we can talk about the example of revenue audit procedures in case you're audited in future. Let me introduce myself. My name is Auditing Saychuk. I'm a managing director with KPMG's technology practice. I audit private startup companies, pre-IPO, IPO companies, and public companies. And you can also see my email in case you'd like to connect. So let's get started. Importance of revenue accounting. As a startup and companies and early stage companies, it's very important to understand that revenue accounting under US GAAP provides standardized approach to revenue recognition. There's only one standard, and it's very, very similar to what IFRS and our European friends are doing. I saw someone was from Switzerland. So this single approach allows every user of the financial statements or financial information to understand how revenue was accounted for, which principles were used, and what procedures were followed to make sure that revenue recognition done in accordance with US GAAP is in compliance. Doing revenue accounting, do proper revenue accounting, enhances understandability and reliability of metrics. Whether you're presenting the financials to your friends, your colleagues, bankers, investors, they will know that how this was accounted for as soon as you mentioned that, yes, this is proper US GAAP revenue recognition. Also, revenue accounting gives the basis for investors and other users to rely on the data. It's not cash basis, it's proper revenue accounting. it's compliance with all the five-step model. It's taking it over time or point in time. It's adjusting for variable considerations or other adjustments. But users will know that they can rely on this data, that it's accurate, and that it's properly reflected the pattern, how the performance obligations have been transferred to your customers. Doing proper revenue recognition also shows operational maturity of the company. A lot of early stage companies focus on cash, focus on invoicing, and I don't blame them. That's what matters. Cash is king, still the case. But once you start doing proper revenue recognition, that shows that, hey, you're on the next level, your next step. You could be step ahead of your competitors. Because again, it's very clear that you've considered this. It's very clear that you've got to a point where it's important for the users of the financial information, and it's important for you as a founder, as a manager, as a team member. And lastly, going to a proper revenue recognition and following US GAAP for revenue recognition is a great starting point to build your internal controls, because you need to follow the procedure, you need to follow the guidance and understand what's going on, which is the basis for the next step. Hey, let's develop these controls in revenue recognition. Let's make sure that we follow the steps. Let's make sure that there's more people in place and there's controls in place. And it's a great starting point. Starting revenue recognition and starting controls over revenue lets you move forward with other steps as well. Let's quickly talk about the five-step model. It's important to mention that the core principle in the ASC 606 revenue contracts with customers is to follow how the transfer of performance obligations of promised goods and services to customers is done, and reflect and record revenue as those promises are fulfilled by the company. The standard lists 5 steps, and we'll go through each one of them, and I'll provide some examples to discuss. But these are very standard steps, and every revenue recognition consideration should follow these 5 steps. So the step number 1 here is to identify a contract with the customer. And it's an important element to keep in mind, because you can have multiple contracts, you can have single contract, you can have a contract within a contract. But it's very clear that to identify a contract, there should be rights to goods and services and payment terms that are identifiable in a contract. The contract has to be approved by the parties. The parties have to be committed to their obligations in a contract. The contract should have a commercial substance, and a very important element, collection of consideration, is probable. This last element on collection of consideration is also a very important one, because you should be thinking of, if I signed a customer, do I expect to collect cash payments from this customer? If you don't, there's no contract in place, and all the revenue recognition should not happen. A very important element to keep in mind that I've seen startup companies not thinking through is a combination of contracts. That's another topic discussed in the standard. And what the topic basically says, that if you have contracts that are signed near or at the same time with the same customer or related parties of that customer, and if contracts were negotiated as a package, or if one contract depends on another, or if the goods or services are a single performance obligation, those contracts should be combined. And a good example here is a SaaS solution, a SaaS offering, a subscription to any platform, to any software or anything like that, that is also sold together with professional services. So if the professional services contract is signed separately, which is usually the case, the company should consider whether those contracts should be combined and treated as the same performance obligation. And the reason that is important is because SaaS contracts are usually recognized over time, while professional services contracts are usually recognized at the point in time. If you combine them, this means that you have to reallocate the considerations, reallocate the payments between the two contracts that will impact your revenue recognition. Obviously, you recognize the PS performance professional services first at a point in time, and then you recognize SaaS subscription over time. How much you allocate if you combine the contracts matters when you recognize revenue and how much you recognize revenue. So that's a very important element to keep in mind that I've seen companies not paying too much attention to. The second step talks about identifying the performance obligations. That is understanding what products, goods, or services have been offered in a contract, and understanding if there is a series of distinct goods or services that are provided in a contract. To make sure that each performance obligation is identified, there's two criteria that need to be followed. One, the promised good or service should be capable of being distinct, and it should be distinct within the context of the contract. So it should be very clear what is promised in a contract, and it should be very clear that this individual service or individual product is an important element that will benefit the customer. If those two criteria are met, each such performance obligation, each such good or service is considered to be a separate performance obligation. If the criteria are not met, meaning a customer will not benefit from the implementation services without the software or without the subscription itself, then those two are not considered separate performance obligations, and they should be combined. An example, in a telecom industry, if you purchase a subscription and you get a cell phone, yes, you can use either of them separately. You can use them, you can buy them separately. As a customer, they will benefit from the two of those separately. Those will be two separate performance obligations. On the other hand, if, again, subscription service, if the implementation is purely for this subscription, if the implementation cannot be purchased separately and it will bring no value to the customer separately, those two are combined as a single performance obligation. There is a definition, there is a term called series of distinct goods and services. It's important to remember that this guidance is not optional. And what it says that if there's a series of distinct goods and services that are substantially the same, that are satisfied over a period of time, and there is the same pattern of transfer, these services should be combined as a single performance obligation. Now, this evaluation is not a straightforward one. If you provide professional services, for example, you can consider that you provide each day as a separate service, or you can say, hey, I provide each day over time, and this overtime, those 30 days or 2 months or 3 months, is a single performance obligation. The reason it matters is because the entire transaction price will be allocated to individual performance obligations. So if it's a series, then you will allocate over the entire series. If it's a day by day, it's a standalone performance obligations, then you will allocate to individual performance obligations and recognize revenue as those individual performance obligations are performed. Again, keep in mind, not an optional guidance, very important to evaluate. There's also a term of immaterial promises in the standard. And what that means that in some cases, your contract can include other promised goods or services that are not necessarily separate performance obligations. For example, you're providing access to your platform, and you have some videos on that platform that help, or learning material that help enhance the understanding and user experience of your customers. Well, the meaning of those additional materials, those videos, might not be as important as the promise to access to the platform. Therefore, such materials, even though they are mentioned in the contract, they are provided to the customer, they could be treated as immaterial promises, and they will not be considered separate performance obligations, meaning there will be no revenue allocated and recognized related to those immaterial promises. Understanding the contract, understanding all the promises in the contract, and evaluating whether those promises are performance obligations or not, a very important step in your revenue recognition journey. Step number 3 talks about determining the transaction price. Obviously, if you have an invoice, it might be very easy to consider what's your transaction price, what's mentioned in a contract, how much you've invoiced, and so on and so forth. But there's other considerations that should be taken into account when determining how much the company expects to get as a result of this transaction. Variable considerations, we'll talk about that in a bit. There is an element of significant financing component, meaning if performance obligations are delivered and the payments are made over a significant period of time, usually more than a year, company should evaluate whether there is a significant financing component. Non-cash considerations. You're providing your service, you're getting trainings back. You're providing your service, you're selling your goods, you're getting marketing from your customer. Those non-cash considerations that are received are also part of evaluation of the transaction price. And consideration payable to a customer. Your company has a customer, but you made a payment to that customer for whatever reason, for whatever service. This evaluation should also be considered to determine what is the total consideration expected to receive from this transaction. Please note that collectibility of this consideration is not part of step 3. Remember, collectibility is part of step 1. If the company does not expect to collect, there is no contract. You should not be recognizing any revenue in that case. Now, variable considerations, that's an important element, and that's a tricky element, and we'll talk about some implementation matters later on. But a number of variable considerations to consider include refunds, rebates, discounts, rights of returns, and so on and so forth. All of these should be taken into account because they impact how much you recognize as revenue and when. There's several methods to estimate this variable consideration, the expected value, the most likely amount. But the main point here is, please keep in mind, if you do not expect to collect the entire amount, if you expect to have a refund, if you're paying royalties, if you will be issuing credits, all of that should be considered on the onset of your contract, at the onset of your revenue recognition, because it impacts your ultimate revenue and it matters for the users of the financial statements. Step number 4 talks about allocating the transaction price to those performance obligations. So once you understand your total contract value and revenue that we recognize, once you've adjusted that for discounts, rebates, refunds, and so on and so forth, and as you understand how many performance obligations are included in a contract, then you allocate your total consideration over those performance obligations. This is done using the standalone selling price concept that is discussed in the standard. The best evidence is the observable price. For example, if you provide your subscription service and if you provide your professional services on standalone basis, meaning if a customer can purchase those products, those services separately, and there is a standalone selling price for those services, that's what you should be using when assessing and allocating your total transaction price between the performance obligations. If you do not sell those standalone performance obligations on standalone basis, the standard says you should estimate. And you should estimate using either the adjusted market assessment approach or expected cost plus margin approach. There's the third method of residual approach, but it's used only in specific cases. In any case, it is very important to remember how to allocate your revenue. And I mentioned this at the very beginning, and we're going back to the same scenario. Assume your total price for your subscription and your professional services is $100, but you, on a standalone basis, you sell subscription at $90 and you sell professional services at $30. In this case, instead of 120, you offered customer $100. It's very important to determine the percentage that relates to professional services and the percentage which relates to subscription service. In this case, it's 90, 30, 120 in total, so it will be split of 25 and 75. And then you will apply this split to your total consideration expected from the contract. So the total consideration is $100, you'll split the 75, 25. That will impact your revenue recognition. Again, professional services likely point in time, subscription over time. That's a very simplified example. Usually when there's contract combination, there's multiple price points related to SSP, that evaluation becomes a bit more challenging. At the same time, again, it's very important to understand that not necessarily what's reflected in the invoice, you said, hey, I'm not going to charge you for any professional services. Not necessarily that's how you will be recognizing revenue. In most cases, again, this concept of SSP should be applied and should be evaluated for revenue recognition purposes. Again, as I mentioned, it could get very messy. It could get pretty complex. If you're in that scenario, I would highly recommend different software tools that help with SSP calculations, allocations, and revenue recognition. In some cases, this could be simplified. But again, very important to remember this allocation principle in step 4. Another element to remember is allocating these variable considerations and discounts, because again, that impacts your revenue recognition pattern. And in both cases, you allocate this based on the principle if you can clearly confirm and state that either variable consideration or a discount relates to one or several of performance obligations and not all of them. Because allocation would follow this pattern. If it's a discount for your subscription, allocate to subscription only. If it's a general discount, split this between the two. And lastly, the final step in the 5-step model is to recognize revenue as the entity satisfies the performance obligations. And there's 2 methods how you satisfy those performance obligations. One is over time, another one is point in time. So for overtime recognition pattern, the customer should simultaneously receive and consume the benefit as the entity performs. The customer controls the asset as the entity creates, or there's entity performance does not create an asset for which the entity has alternative use, and there's a right to payment for the performance to date. In those cases, you would recognize revenue over time. For point in time, that's somewhat simpler because you've passed on the goods or services to the customer. They have physical possession, they have legal title, and they bear the risks. And there is an obligation to pay, and the customer accepted the asset. So point in time is much simpler, but this evaluation, whether it's point in time versus over time, that's another important element in your revenue recognition journey. I do want to talk about some implementation guidance and some of the challenges that I've seen early stage companies face. that I hope will be important for you to remember and implement or evaluate for implementation purposes as you go through your 606 accounting journey. The first challenge relates to warranties. And the guidance says that you should be evaluating whether a warranty is a separate performance obligation or not. And you can see the steps listed here, but ultimately, the evaluation whether it's a separate performance obligation or not will impact, again, your revenue recognition, because remember, you have to take the entire transaction price and allocate this between the performance obligations. So if you've considered that warranty could be purchased separately, or if you consider that warranty is more than just the promise that the asset will perform or the service will perform, you should carve it out as a separate performance obligation, and you will allocate your consideration there. You will recognize revenue only when this performance obligation is satisfied. Again, there could be a deferral of revenue because of warranties, so you should be thinking about those promises in your contract. A slightly different story relates to the rights of return. The standard says if the customer has a right of return, no revenue should be recognized until you're confident that they will not exercise that right of return. The right of return, unlike warranty, is not a separate performance obligation. But the company should evaluate and should estimate the returns based on history, based on similar patterns, based on other companies, because this right of return gives rise to a variable consideration, meaning you don't expect to receive the full revenue because you will give it back because of the right of return. And in this case, the company should record refund liability and maybe an asset if those assets will be brought back to your books when returned. Different concept, but worth evaluating between warranties and the right of return because it could have different impact. It has different impact on your financial statements and financial results. Several other implementation challenges that I've seen relate to customer incentives. All of these have relevant guidance. All of these are discussed in KPMG book on revenue recognition and impact different steps. So if you have, or if you've seen cases where there's upfront payments to customers, volume rebates, free or discounted goods or services, or customer options for additional goods or services, all of these matters require additional attention. All of these consideration should be separately evaluated for the impact on revenue recognition. Again, there could be various cases, different scenarios, but something to definitely keep in mind, as such transactions and incentives could impact the amounts that you reflect as your revenue. An interesting one relates to options to acquire additional goods or services. There is a concept of a material right. So if the customer is not able to obtain the right to acquire this good or service without entering into an agreement, and the option gives the customer the right to acquire additional goods at the price that is less than the standalone selling price. Basically, in this case, the company has given a customer a material right to buy something in future at a discounted price. And that material right should be evaluated as a separate performance obligation, and that material right should get an allocation of the entire transaction price. And it will be deferred until the material right is delivered as a performance obligation or exercised as a performance obligation. Again, we're talking about deferring revenue and allocating total proceeds, allocating the total consideration to another performance obligation. Therefore, you need to be very careful with contracts that offer significant discounts for some future purchases and evaluate whether those create material rights And again, remember that, hey, this has to be accounted for separately. This evaluation for the material right involves a number of considerations: qualitative, quantitative, current practices, future practices, and so on and so forth. So it's not a straightforward step. And I have seen the companies, again, not paying much attention, but it's absolutely worth something to remember. Now, if your discounts offered are not significant, maybe it's not an issue, even if you do have those promises, future promises, because that's how you market your products. But again, it's a step-by-step evaluation. It's a detailed analysis, whether you should be deferring your revenue or not. It impacts the results. Another item to remember that is widely discussed and has significant impact is the principal versus agent consideration. Especially with SaaS providers or with platforms, in a lot of cases, what's being offered on a platform is not the platform itself. There's resale of someone else's products, someone else's services. There's combination of two products or services. And in this case, it's very important to understand if the company acts as a principal or if the company acts as an agent, because that matters how revenue will be presented and how revenue will be recognized. A principal that is responsible for the transaction, that controls the specified good or service, recognizes revenue on the gross basis. An agent will recognize revenue on net basis, meaning here's how much I received from the customer, here's how much I paid to vendor or to actually service owner or product owner. That matters. That matters a lot. Now, the criteria for evaluating whether an entity acts as a principal or an agent are around control. So who's responsible for fulfilling the obligation? Who has the inventory risk? And in this case, inventory does not necessarily mean a physical possession. It could be possession of software or a SaaS solution. And also who has discretion in establishing prices. There's no one answer that fits these criteria. So it's a combination of, again, evaluation steps, qualitative, quantitative, that will give you a solution in the question who acts as a principal versus agent. At the same time, I have seen cases where that evaluation was very important and led to some significant decision-making steps in companies' journey. One item that I absolutely encourage everyone to become familiar with as it relates to implementation relates to contract modifications. That's an important element that, again, impacts your revenue recognition, and understanding how the standard works and what steps are taken to evaluate a contract modification is going to be critical in proper revenue recognition. In a lot of cases, your initial contracts, your initial order forms will be changed. Whether you issuing a credit memo, whether you providing additional services or new subscriptions, whether you're selling extra products, or maybe the customer wants to downsell and remove some of the seats or remove some of the products that were initially agreed upon. The next step when something like this happens should be considering if it's a contract modification in accordance with ASC 606 and how to account for it. Some contract modifications are accounted for on a cumulative catch-up basis, meaning you will adjust revenue that you have recognized to date. Some of the contract modifications are accounted for prospectively, and some contract modifications are also prospective, but that's now a new contract and a termination of the previous contract. So each of those steps require separate evaluation. Each of those scenarios could have different impact on your revenue recognition. But understanding how that works and implementing proper approach to accounting for contract modifications is a critical step in your revenue recognition journey. two items that I have seen startup companies not thinking of at all as it relates to revenue recognition relate to cost to obtain a contract and cost to fulfill a contract. So the accounting standard says that if there are costs that originate the revenue contract, and a good case or good scenario here is the commission. So you have your sales agents that are selling your products or services, and you pay them commissions. Those commissions could be eligible for capitalization. There's a number of criteria that need to be met before this capitalization can occur. But in a lot of cases, capitalizing the commissions paid and then amortizing them over the life of revenue contract or customer or average useful life is a big adjustment to your financial statements. You don't expense everything. It's not a P&L hit. You capitalize and you take it over time. A similar case is with cost to fulfill a contract. So if there are costs incurred in the contract fulfillment, these costs should be capitalized. So if you have a customer that asks to create something for you, or you know that you need to create a product, or you need to create a software tool for the customer to be able to use this, such costs should be capitalized. And again, recognized as expense over time of that contract. There's a number of costs that could be included in this capitalization: direct labor, materials, allocations that are directly related, and costs that should be excluded, like G&A, waste, relate to satisfaction of performance obligations and things like that. But it's still an important element to remember that not all of your expenses related to revenue recognition and related to costs, contracts for revenue should be expensed right away. It's a tricky element, might not be important at this point, but if you strive to have your financial statements, financial information be as close to US GAAP as possible, these two concepts should be kept in mind all the time. That's it on my accounting journey. I do want to talk to you for a couple more minutes on example of audit revenue procedures. This is what I do on a day-to-day basis. And I would like to share the approach to auditing revenue. So in case you're audited, when you're audited by external auditors, by investors during an M&A due diligence process, you know what to expect. It's all around the 5-step process. And majority of the steps in auditing revenue would be to reperform the revenue recognition and 5-step process. Before we do that, obviously, as an auditor, we need to understand the accounting policies for revenue recognition, evaluate the appropriateness of that accounting policies, perform some general reconciliations, and things like that. But the true testing starts when you perform substantive analytical procedures or you perform substantive sampling. When it comes to substantive sampling, it's basically picking several contracts and reperforming revenue recognition and going through the 5-step process to understand whether all 5 steps have been properly performed and whether revenue has been recognized correctly. We usually get the contracts, the purchase orders, invoices. We also get proof of delivery, again, to evaluate the step that revenue is recognized when performance obligation is satisfied, when the goods or service are delivered. And we do get the bank statements to tie this all out against the cash proceeds and so on and so forth. And in most cases, the goal is, again, to recreate the pattern, the 5-step model, recreate revenue recognition, and compare to how the company recognized revenue versus what we recalculated for our samples. We could be doing analytical procedures associated with revenue, and in a lot of cases, we do analytical procedures for revenue recognition, but it's not applicable to all the industries or examples. So when we're talking about the subscription business and revenue that is recognized over time, cash doesn't really matter. But when we talk about retail or payment tech or things that are more point in time, in that case, the payments and cash used in analytical procedures could be very relevant to revenue recognition. So the goal here is to understand the pattern, understand the payments, and perform analytical procedure to come up with expected revenue for the period based on cash collections during the year or during the period. In those cases, obviously, there should be adjustments for any opening accounts and closing accounts receivable, deferred revenue, any reserves, and so on and so forth. But if cash collections are pretty consistent to revenue recognition, this is the way to approach auditing revenue. And lastly, as it relates to deferred revenue balance, we also usually perform sampling approach. What we pick the samples from the deferred revenue and then get the contract, invoices, payment. And the goal is, again, recreating the 5-step process and recalculating the deferred revenue balance at the end of the year. We also do perform the roll forward approach, where we evaluate in totality and evaluate for the completeness of revenue, where your deferred revenue balance and your revenue balance are closely correlated. So the goal here is to recalculate of how much was invoiced, how much was recognized as revenue, and how much is left in deferred revenue. It's a bit more challenging approach, but if you do this on your own, if you build yourself roll forwards like this to make sure that, hey, your revenue makes sense, that's a great way to check yourself. And that's exactly what your auditors might be doing when performing audit procedures over revenue or over deferred revenue. I hope this was helpful. Happy to open this up for Q&A session.
Amazing, Oleksandr. Thank you so much. There was a lot in there, but it was really good stuff and very, very important. And we're seeing through the chat that this is all good stuff. So if you have questions for Oleksandr, drop them into the Q&A box. And we already got some. So Oleksandr, if you're ready, I'm just going to roll through them.
Absolutely.
Amazing. Let's see. We'll start off with a pretty basic one. What industry standard software can you recommend to use at my startup that streamlines accounts and finance reporting, especially as we seek to pilot our solution with partners and earlier adopters?
Thank you
Can
for the
start up.
question.
Yeah.
So I don't want to, and I should not be recommending software solutions for independence reasons, but I did ask a similar question to my Copilot, and Copilot suggested several software solutions that some of them are free of charge, some of them are paid. Copilot said that Wave Accounting, Zoho Books, or Zip Books are free of charge software solutions that help with invoicing, some help with revenue recognition. If you want to scale and you want something more advanced, then Copilot suggested to use QuickBooks, Xero, or FreshBooks. Most of the companies that I've seen use actually NetSuite. There is a revenue recognition model in NetSuite that also helps with a lot of revenue recognition. But again, there's so many software solutions out there, from very, very advanced and complex to something very simple. I would, again, suggest you explore and try out what fits your needs most.
Yeah. I think that's great advice. Thanks to Copilot and you, of course. And I think it depends also on what stage of business you're at, right? You don't want to pay for like this full enterprise suite if you're pre-revenue and you're just figuring things out, right? So, it all
Absolutely.
depends on what.
Again, I've seen like hundreds of thousands and dollars worth of software, but if you don't need that, don't go there.
Yep, great advice. Okay, got a question here from Julia. What are the top habits you recommend early stage entrepreneurs as a daily, weekly, monthly basis to stay compliant?
Oh, that's good. I like reconciliations. I'll definitely suggest doing those reconciliations between, hey, how much I've invoiced, how much I've collected, what's in my revenue, what's in my deferred revenue. That's very helpful. Reviewing your accounts receivable balances, if there's any, on regular basis. Reviewing your customers on regular basis. That's always helpful. But I would say that again, doing reconciliations, that's probably the key in this case if you want to make sure that, hey, it all ties together, it all makes sense.
Amazing. Okay, this one sounds like a word problem in a math class, but they asked it, so let's see. If you offer three courses and an incentive discount price, if you purchase all three as opposed to one course at a time, how is the revenue allocated?
Um, Again, the question is, what is your performance obligation? And I would say my initial guess would be that each course is a separate performance obligation because you can sell them separately. You can sell them, well, at a separate price. They're clearly likely called out in a contract that you've offered these three courses. So in that case, the next step to evaluate would be, is your discount, was it for the specific course and can you adjust it only that one, or was it a general discount? If it's a general discount, I would then say that you probably should allocate your discount to the three courses, and as the courses are consumed, you would then recognize your revenue.
That's great advice. Well done, sir. Let's see. Question here. Revenue recognition for construction when the cash is collected versus when there's a delayed in the job starting.
Construction is a separate beast, I would say. There's a lot of considerations there. Um, I do not want probably comment, so I don't confuse you in this response. I would recommend again going through KPMG handbook on revenue recognition. I'm pretty sure we have discussions there on construction and evaluating all those elements. I don't think, again, cash collection matters at all in this respect. Again, the standard is the same for any industries. So you recognize revenue as you complete your construction, as you deliver your service or your product, but not based on cash collection. But
Great.
again, there's other considerations that I would highly recommend taking a look at.
Okay. Amazing. Let's see. There's another question here. Should billed revenue be in deferred revenue or only if cash is collected in advance of revenue recognition? I think you just kind of answered that.
I can comment on this as
Yeah.
well. Um, Billed revenue, as long as you invoice and as long as you're entitled to invoice, that goes to deferred revenue right away. So it goes there. Collection will adjust your accounts receivable, obviously, but collection on its own does not impact your deferred revenue or your revenue recognition. And that's the whole point that standard introduced. I mean, the old standard had something similar. It's not based on cash collection. It's based on how you transfer your performance obligations. That, if you remember that core principle at the very beginning that I mentioned, that it doesn't matter. It matters how you deliver the service or how you deliver the product. Now, what I have seen is sometimes companies will issue invoices way in advance, even though they are not even entitled yet. So hey, I'm going to bill you 3 months in advance, and my delivery of service is in a quarter or something. You need to be careful on the timing of that invoice. When will it result in deferred revenue versus not? Because If you're not entitled to that yet, but it's for convenience purposes, you send the invoice way in advance, I would not be putting that as a deferred revenue or even account receivable. Now, it's a contract by contract scenario, and in most cases, if the customer accepts the invoice and you are entitled to that invoice, yes, that's a debit account receivable, credit, deferred revenue. And again, collection will not impact how you recognize or how you account for deferred revenue. If you don't expect collection, so if you have a new customer, you've issued an invoice, but you're not confident that the customer will pay, in that case, I would be very careful considering, do I even have a contract? Should I be putting anything on my books in this respect?
That's super good advice. And I got A's in my accounting classes in college, Alexander, but I've learned more from you in an hour than I did in many years. So you're doing
That's
great.
funny. This was very quick. This accounting standard is one of the most complex ones. So again, the book is humongous, a lot of issues, a lot of fun stuff.
Oh, yeah, it's all good things. Another question here, is the revenue accounting method the same for private companies as for public companies?
Yes, there's no difference between public or private companies. As I mentioned before, there's very little difference between US GAAP and IFRS. So it's the same standard. I did not cover the presentation of the financial statements and requirements there. I'm not convinced that that's very relevant for this seminar, but there is some difference as it relates to the presentation between publics and privates, but accounting-wise, it's the same.
Okay, great. Um, Sounds like we've got a seasonal startup out here. What are some tips on how to budget, account for revenue recognition when work fluctuates seasonally?
Um, well, that's a very good question. You can have adjustments for your seasonality. I mean, if you know what how seasonality works in your industry, I would definitely recommend doing that. I know that there's a couple FP&A tools or platforms that help with those projections.
Mhm.
Um, I like Excel models to adjust for seasonality. But then again, it all depends on what data you have. It all depends on the industry data, on your understanding and things like that.
Hmm, that's good advice. Alrighty. Um, so just rolling through these questions. These are all good questions, folks. All right, let's see. Um, are there some foundational tips that you would recommend a startup get done before starting to generate revenue?
Um, think about it, how you will um, account for it, who will be doing this, what data do you need? Because that depends. Again, in a lot of cases, you use some software tool to help you with revenue recognition. And applicability of one software tool or another depends on what information you have and from what information is available in your industry for your company, how you operate. Because all the tools, they will require some input. Obviously, you can keep your customers in those tools. You can be doing invoicing from your tools. But if you already have something in mind, maybe you don't need a full-blown suite of tools that will be doing all of this. So I think that that's an important consideration when before you start generating is what data do I have? What information do I have? How do I see it? And then you can go to selecting tools, and then you can go to designing the process on how you will be invoicing customers, how you will be accounting for, how you will be doing your collections and things like that. So try to build it out in your mind. Try to build it out or see how others are doing. Ask around. But I would again, it matters what you start using because as soon as you start getting customers in one tool or one software, it's probably going to be a challenge to switch. So the more you think through ahead, the better.
All right, we're almost at time, but I want to get to a couple of more of these questions if we can. All right, so Oleksandr, I've got the tools, I've got my strategy, I've got everything that you just talked about. What are some questions that a founder should be asking someone when talking to them about being their accountant, their CPA?
Oh, that's a good one. Um, Obviously, experience matters. Um, I would absolutely ask about the specific industry experience. As I mentioned, construction, that's a separate beast. Software, that's another beast out there. The revenue recognition for software, for construction and things like that is unique and doesn't follow some of the guidance because especially for software, you need to be understanding licenses, post-consultation support, royalties, and things like that. So if you're in that industry, make sure your accountant has relevant experience. Now, I'm a big proponent of learning. So obviously things could be someone can take courses, someone can take additional classes and things like that to understand. It's not rocket science, but the more experience obviously they have with a specific industry, with specific questions, the better in your case. What also matters is the, again, software that they use. I like Excel, but hey, that doesn't work all the time for revenue recognition. Um, so their familiarity with software, their familiarity with tools that help with revenue recognition. I assume you might have your own software at this point where you keep your accounting records, where you keep your invoicing and things like that. Make sure that the person has experience there too.
Great advice. Well, Alexander, we are at time, so thank you so much for joining us today to share all of your knowledge and expertise in this area. Just really appreciate it.
Thank you for hosting me. Thanks, everyone.
Amazing. And you could reach out to Oleksandr and learn more about KPMG, and those links in the chat. We'll follow up with more information on this. But on behalf of everyone at the center, thank you for joining us today. We'd love you to join us for our upcoming webinars, so keep a look out for those in the link in the chat. And of course, we look forward to welcoming you all back online. Thanks again, Alexander. Have a good one.
Have a great day. Thanks, everyone.